All right, Armando, we are live and the participants are starting to roll in. Good afternoon to our friends here on the East Coast and good morning to the rest of the country. I'm here with my partner in crime, Armando Testani, who we just went down memory lane and have known each other for 20 plus years. Armando is the retirement services specialist in the marketing department of Security Mutual. When it comes to qualified plans, he is as good as it gets. So Security Mutual is a carrier partner of ours. They put a ton of resources into their qualified plan divisions. And I think you'll see by today's presentation that they really know their stuff. So, if you've been on these calls in these webinars with us prior, you'll know that we are big on income tax and retirement planning. We promote the use of covered assets and volatility buffer, and you'll see how we can use DB plans in various forms to accomplish those particular goals in the income tax and retirement planning space. So just a quick agenda. Today we're going to teach you what is a defined benefit plan. Just start off really slow and then give you the ideal client. Right when I came into the business in 1999, the qualified plan department at Security Mutual had to teach me that not every business owner was a good fit for a defined benefit plan, right? And you'll get to know that once you see the demographic that Armando and I share with you. We'll talk about fully insured plans. So this is a type of defined benefit plan that really hits home in the life insurance and annuity space. So you're going to see exactly what they are. They've become much more attractive now that interest rates have turned, and you'll see a couple examples. We're going to show you how to buy life insurance in the defined benefit plans, and then how to exit the life insurance, or maybe not, when it comes to retirement age and in the event of your desire to begin income planning and estate planning. And then we'll teach you how life brokerage and Security Mutual can help. So we're going to jump right in, and I'm going to tee up a series of questions for Armando, and we're going to get the technical answers from him. And I'll keep this presentation moving with a bunch of questions and get into some real life examples, and then application on how to use the DB plans in your income and actually even in estate planning allocation. So Armando, let's just get started straight from the IRS. Like, what is a defined benefit pension plan?
Well, a defined benefit pension plan, this is per the IRS, as you can see here. It's a plan that provides a fixed pre-established benefit for employees at retirement. Its contributions come from the employer, not employees. So that's one important thing to keep in mind, unlike a defined contribution plan like a 401k plan or something similar where the employees defer into the plan. A defined benefit plan, all of that contribution comes from the employer. You're going to get a fixed benefit upon retirement. So they're trying to fund for that fixed benefit at retirement, future benefit. And oftentimes with these type of plans, you're going to get plans with very large contributions, especially when you have participants who are older in age with higher salaries. And one of the benefits of those type of plans is that, especially for business owners, is that they can often get a very large tax deduction at the end of the year, every year that they have one of these plans in place. So a defined benefit plan is something where you're stocking away large amounts of money to get a benefit upon retirement, whether it's a lump sum benefit or a monthly benefit. These are things that we're actually going to see a little bit later on in this presentation. But defined benefit plans are a great way to put a lot of money away for retirement and get a large tax deduction at the end of the year as well.
All right, Armando. So I'm gonna be a bit juvenile here and just kind of give you an example of how I see the differences between defined contribution plans that most of the society is accustomed to using, like a 401k or like an IRA, versus a defined benefit plan. When I met you, I was 25, 26, 27 years old, and I had a set amount of money. It wasn't all that much. And I knew that I could spend that money, and I wanted to stretch that and take that as far as I can go with it. And whatever it turned into, it turned into. That was like, we had a lot of fun and no children or married. And we really just like fulfilled our budget with whatever we could afford. Today, I'm much older and I want to know exactly where I'm going. and I'm willing to pay for the certainty that I get exactly what I'm looking to get, because my nights out and my social and my meals and entertainment are far and few between with 4 kids. So I want to know exactly what I'm getting and where I'm going. So therefore, I'm willing to pay the additional contribution to meet that defined benefit, right? So it's a little bit in simplistic form, but you really get to understand the differences between let's see what happens versus here is where I'm going. So give me an idea. You said that you can make some pretty big tax deductible contributions. What are the limits?
Well, for a defined benefit plan, the limit is based on an individual's age, their retirement age, and then the IRS also sets an amount that you can fund for per year, which in this case is $245,000 per year. That's the maximum. It's not the maximum contribution, it's the maximum how much you can get from the plan on an annual basis. So that's a lot of money for a lot of people. Getting $245,000 out of a plan is going to be a lot. And the older you are, the more you can actually put into the plan in order to get to that $245,000. And that's because you have less years to fund to the plan. With defined benefit plans, normal retirement ages are usually either age 62 or 65. So say, like myself, I'm a 47-year-old, I'm trying to fund for retirement, I'm going to go to age 65 because that's the maximum NRA that we can use as of now. I anticipate at some point they're going to raise it to 67 to coincide with other retirement ages as well. But for now, it's 65. That's the maximum. So as a 47-year-old in a defined benefit plan, I could put away, maybe $150,000, $200,000. But say I was 55 or 60 and my retirement age is 65. In order to get to that 245, I'm going to have to pocket away more money into that defined benefit plan so I can get to that 245,000 upon retirement. So the older I get, the more I can put away into the plan. Now, if I was 30, I have more years to fund this plan because I'm going to age 65. I have 35 years. So I don't have to, not have to, but I'm limited to how much I could put into the plan. The older you are in these defined benefit plans, the more you could sock away because you have less years towards retirement. You have less years to get to that $245,000 a year in a benefit from the defined benefit plan. So that's how the defined benefit plans work. We're looking at that target number and we're saying, how much do we need to put in given this person's age in order to get to that maximum amount?
So Armando, just to clarify, that $245,000 a year, that's based off of a life income, right? So that is a lifetime of $245,000 payments.
Correct.
Beginning
if they decide to go that route. Correct. They can always take a lump sum at retirement now, and that's something we're going to show a little bit later. But if they want to go that retirement route and get that 245 year, what they're going to do is they're going to annuitize that lump sum, and then they could get up to that $245,000 a year. Now, keep in mind, that's the maximum we could do. Defined benefit plans, you have a lot of customizing in those plans. So you can either do the max, or you could say, I only want to put away $200,000 a year. And so then that benefit's going to be a little bit lower based on retirement, based on how much you put into that plan.
That's a staggering number, Armando.
Oh, definitely. Especially when you're dealing with defined contribution plans where the maximum you could put in is, $61,000 a year. $200,000 is, and for individuals, they can go much higher than 200, 300,000. That's a staggering amount, like you said, compared to a defined contribution plan.
Per participant.
Per participant.
Yeah.
Right.
So who are we looking at? Right. I opened the presentation as a trip down memory lane, and I would send a fact finder in on every business owner I've ever met because I love the concept. But who are we really targeting?
We want to target mature, and by mature, I don't mean how we used to be when we first met each other as 20-something-year-olds, but older clients, people who are more mature in age, closer to retirement. You want to target people who are affluent, people who can actually make these contributions on an annual basis, not somebody who's like, hey, listen, I got a chunk of change this year because I sold my business or we signed a contract and it's a one-year contract. I want to put away as much as I can this year and not worry about other years. Unfortunately, you can't do that with defined benefit plans. You have to have an ongoing contribution. We like to say a minimum of 5 years you fund the plan. Anything less than that it could set off alarms with the IRS, and they could say, hey, you're not actually using this for retirement. You're using this more as a tax shelter. So we like to say somebody who's stable and can fund these plans for a minimum of 5 years. Another thing is the fewer employees, the better. Now you could say, how come? Well, I'm a business owner. I'm 55 and I have 7 employees. All of my employees are in their late 40s or 50s, and they all make more than $50,000. But I only want to put away $350,000 into the defined benefit plan. Well, now you have 8 people, all older individuals, all mature individuals. They're making 50,000 plus, most of them. You're going to be putting away large contributions for those individuals. Some owners have no problem doing that. Some owners don't mind because they see, hey, it's a tax write-off. I'm taking care of my employees and I'm still saving for retirement. To be frank, a lot of owners don't have that mentality. A lot of owners were like, I want to put away as much as I can for myself and as least as I can for my employees. So that's why we say the fewer employees, the better. In defined benefit plans, we like to have like a 1-to-3 ratio. For every owner, a maximum of 3 employees. That's when it'll really work the best. That's when you'll see numbers where owners are getting 80 to 85 cents for every dollar that they're putting into the plan going to themselves. Anything more than that, you're going to start seeing the numbers drop a little bit. So that's why we say the fewer employees, the better. And lastly, committed. I think I already talked about this, but you want somebody who can commit to this plan for a number of years. You don't want a one and done type of person for these type of plans.
All right. So we touched on a few really key points here. Mature, affluent, income is stable, can't shelter a bubble of income, which we're seeing a lot of through the merger and acquisition space. Fewer employees. I like the 3-to-1 ratio, Armando. I am starting to see a little bit beyond that, maybe a 4 or 5, if there are some key folks that the business owner is looking to retain and reward.
Oh, certainly.
And 100% committed, right? The IRS says these plans need to be permanent and ongoing. And
Correct.
5 years really does show a permanent and ongoing mentality and
Right.
intent. So, all right, defined benefit plans are covered under Section 412. We're not going to bore you and read Section 412, but give us a couple different variations of these types of defined benefit plans, and then specify the ones that specifically use insurance products, Armando.
Sure. Defined benefit plans, there's generally 3 types of defined benefit plans. The first I'm going to just briefly talk about cash balance plans. Those are defined benefit plans that look like a defined contribution plan. We're really not going to get into that today. And those actually work well, like you said, when you're seeing businesses with 4 or 5 employees, some highly competent employees, because you have a little bit more flexibility in the design of those type of plans. And honestly, that's a topic where we could spend another hour just on that type of plan. For today, we're going to talk about these 2 plans here. These are the other 2 types of defined benefit plans. We have 412(e)(3) plans and traditional defined benefit plans. With 412(e)(3) plans, people might be familiar with the old 412(i). Basically, a number of years ago with the Pension Protection Act of 2006, they changed the code from 412(i) to 412(e)(3). Nothing else really changed for these type of plans. The verbiage stayed the same, they just changed the code. They got a little bit more stringent in their enforcement of the code, though, because a lot of people were using different types of funding methods, springing cash values. One company was doing it just with life insurance. So when they changed the code with the PPA 06, they said, we're going to get more forceful in the enforcement of these particular type of defined benefit plans. And that's the 412(e)(3) plan. Now, the 412(e)(3) plan, you can fund it one of 2 ways, either an annuity only or a blend of annuity and whole life insurance. Those are the 2 options that you can have. They're individual insurance contracts. You're using products with guaranteed interest rates. So the investment risk is placed upon the insurance company who's issuing the products and not the trustee of the plan. These are funding stable, very predictable. What you see on the illustration is what you're going to get on an annual basis for contributions in these type of plans. And again, it's an annuity only or a blend of annuity and whole life insurance. And these are great for people who are risk adverse because you are using these guaranteed products. Now, if you have somebody who wants to put away a large amount of money, but they want a bit more flexibility, that's where you go with a traditional defined benefit plan. Those type of plans, you can use whole life or UL insurance in the plan. Doesn't matter, it's your choice. The plan trustee bears the investment risk because they can use guaranteed products, non-guaranteed products. They're not beholden to just an annuity. They can use an annuity, a GIC, stock, bonds, mutual funds. You can even fund a traditional defined benefit plan with real estate. I've seen that done before. It could be a bit of a pain, but it's doable using real estate. Now, these type of plans, the funding fluctuates with the investment risk as well. So if you're earning more in the plan's contributions can go down. If the products that they're funding a traditional DB plan with are having some, down years, lower interest rates, more can go into the plans. And then one thing to keep in mind, these type of plans all have to be level funded at the end of the year. When somebody leaves the plan, you got to make sure it's level funded in order for that participant to get the retirement benefit at retirement as well. So those are the two types of defined benefit plans that we're going to be discussing today, the 412(e)(3) plan and a traditional defined benefit plan as well. And we're actually going to give a couple demonstrations, I think, of the 412(e)(3) plan as well.
Yeah.
And both of these plans can use life insurance. They are actually, all qualified plans can have life insurance in them as long as the plan document allows for it. And we have a TPA firm here at Security Mutual who's been in business for over 40 years dealing with these type of plans. All of their plan documents, it's literally just a little box you tick that says life insurance is permitted investment. And one thing to keep in mind, which we're actually going to talk about in a little bit, is the type of life insurance we use in these plans is going to be a unisex product as well.
Yeah, well said, Armando. So just one key difference, right, that I just want to just drive home. In the traditional DB plan, right, I'm still driving to, let's say we're fortunate enough to be able to fund the max and we get to the max, 245,000 of lifetime income beginning age 65 that's my destination. And it's the same destination, whether I use insurance products or investment products. But over here, if I desire to use, let's say, American funds, right, a blended portfolio, 60-40 American funds, and I have wild swings in the market like a -10 or a +15 or a -7, I'm still driving to the same destination. So my contributions are going to go up, they're going to go down, and the assumption that I'm using versus the reality of the return could keep me on my toes every year, right, per se. Where the fully insured plan, you know exactly what you're getting. The fully insured plans, quite frankly, were not that attractive over the last decade because markets were flying high. The guarantee annuity rates were 1%, but they were only paying like 1.5%. So who really has a good time investing their pension assets at 1.5%, right? So even though there's some benefits to that and larger tax deductions, now we see the pendulum kind of shift, right? The volatility in the market is a reminder that markets are volatile. I think we did experience a pretty good run there that may have been an anomaly with like 9 or 10 positive years. And now that interest rates have somewhat normalized, the insurance products are paying more than their guarantee, which help us going forward and becomes a lot more palatable to get to our destination, knowing that we can now earn 4 or 5%, which I won't steal your thunder there, Armando. We're going to jump into that in a bit, but just want to bring to light some of the reasons why we really started looking at these programs even closer than we have in years past, particularly on the 412(e) side, side of the ledger here. The traditional DB has always been a plan that we've embraced, right? The 412(e) gives us a little more certainty and becomes a little more attractive in today's environment. So let's spend a little bit of time on these. There's all insurance guys on this phone and on this webinar. And although some do investments really well, everyone still likes to sell life insurance and annuities. Certainly not at the expense of the consumer, right? So the comments I just made are more relative to the consumer than to the agent, right? Where interest rates have normalized. You're looking at 4% yields on annuity products. You're looking at 7702 based whole life type products that accumulate much better. So I want to focus on the fully insured defined benefit plans for a moment here. So we talked a little bit about limits. Give us the key numbers in the key metrics for determining what contributions look like and the benefits you can pull out, Armando.
Sure. In 2022, the DB individual limit, as we mentioned, is the $245,000. Now we have what they call the compensation limit, and that's $305,000 for this year. Now, what that means is, regardless of your income, the maximum salary we use when we can design a plan is $305,000. I've seen plans come in where you have individuals making $700,000, $1 million a year, $1.2 million, and agents are like, he wants to put away $1 million a year. I'm like, that's great that he wants to put away $1 million a year, but we still have to abide by the IRS and the DOL limits. And they state we only have $305,000 that we can use out of his salary. And I say only when, wishing I could only have a salary of $305,000 a year. Sadly, I don't. But that's the compensation that we can use when designing these sorts of plans. And that's any qualified plan, whether it's defined contribution or defined benefit limit. And another important thing to keep in mind is what we call the highly compensated employee limit. Now, you see here it says $135,000, but it's not how much they make this year in 2022. It's how much they made in 2021. Then if they made $135,000 or more, or they own more than 5% of the company, they're considered a highly compensated employee. And why do we say that? Well, for testing purposes. And you can discriminate against highly compensated employees. You cannot discriminate against non-highly. Well, that's not true. You can, but it's very stringent in how you can discriminate against highly compensated employees. Because, as you pointed out earlier, you could have a client who has that highly compensated employee, and then they have 5 or 6 other employees. They might not be highly compensated. They can still do a plan like this, a defined benefit plan, but then you can kind of carve out the highly comped person and some of the non-highly comps as well. So you're not giving as much to the employees, and then you can offer them, like a profit sharing plan or something else as well. So there's lots of things you can do when you have highly compensated employees. So those were the 2022 numbers. 2023, we're seeing a significant increase in contribution levels across the board for defined benefit plans and for defined contribution plans. As you can see here, the DB limit now goes to $265,000. The most we ever saw increases would be $5,000. There were some years where there were no increases. So to go from 245 to 265, that's a huge jump. We've never had anything like that before. Same with the compensation limit. Lots of times that was just a $5,000 increase on an annual basis. This year we're going from 305 to 330, $25,000 increase. In the past that took us 5 years to do. Now we're doing it in 1 year. Same with the highly comp, 150,000 from 135. So we're seeing these large increases in 2023 that are coming. And I think that's going to be great, because that means now, hey, we can put away even more into these type of plans than you were seeing that incremental increase in years prior. Now you're going to see a bit larger increase when it comes to 2023. And one thing I actually want to point out that went into effect in 2022, people might not know, is, prior to 2022, if you wanted to put a plan in place and your client was on a calendar year, it went from January 1st to December 31st. You don't have to worry about that anymore. Now they have actually until their tax filing date and any extensions to get a plan in place. So they've kind of made it easier for employers to get plans in place. You would have people scrambling. Prior years, it was just November, December was my busiest time of year because people were constantly sending in stuff. Hey, we know we have to get the design done. We have to create the plan document. We have to get all of that done by the end of December. Now it's slowed down a bit because people know, hey, we have until tax filing date. So they have until April or maybe even September on most plans. Some plans, like defined benefit plans, I would not recommend any client waiting that long. I would tell them, get that done as soon as you can, because it comes to funding issues. If you have a client who's putting away a traditional DB plan or a 412(e)(3) plan, and they wait until September to put the plan in place for 2022, they're going to have to fund that plan as well by tax filing date, because all plans have to be funded by tax filing date. So they might be like, oh, where am I going to get $400,000 to put away in 2 weeks? Well, that's why we like to say with defined benefit plans, try to get those plan documents done sooner so you have more time in order to get to the funding by the tax filing date. But yeah, 2023, we're going to see a very large increase in all of the plan contributions. And I think that's going to help a lot with defined benefit plans. You're going to see some large increases. And you actually see a little screenshot on the side there. And that's a nice little flyer that we offer as well that shows all of the different contribution levels for defined benefit and defined contribution, as well as stuff like IRAs as well. And then it gives you a historical background for the past 4 years. So that's something we offer. I can email, you can email to your guys. And we also have it on, our public website that's available to download as well. Just
Good
wanted to
stuff.
point that out.
Good stuff. Yep. There, Armando. So a couple key takeaways from this slide. You can sock away more than ever because the DB individual limit went up. The IRS helps you get there a little easier because they've increased the compensation limit. You can pick on your highly compensated folks a little easier, a lot easier than your non-highly compensated folks. And they made it a little tougher to qualify it as a highly compensated employee, likely because of inflation and wage increases. Right. So if you have 4 employees and 2 are highly compensated, and 1 is age 65, you can, in theory, remove them from the plan. And what you thought would be a poor allocation of funds to retirement planning now becomes super attractive just because we were able to remove that one person. And you couple that with a non-qualified offering or some type of cash bonus to make sure they don't feel completely neglected. And you have a win-win for the entire team. Right. So really good info. So what is a fully insured plan, Armando, and how does the insurance industry get themselves involved in these types of programs?
Sure. The fully insured plan, as we like to call them, they're the section 412(e)(3) or 412(e)(3) defined benefit plans. They have the annuity and the whole life insurance, but they must be issued by the same company. So you can't go to company A and get the annuity and company B to get the insurance. You got to get both products from the same company because they use guaranteed purchase rates, guaranteed annuity rates on these as well. So that's how come it comes from the same company. You've got guaranteed level premiums in these types of plans, and you know what the benefit is going to be at retirement. Because you're using these guaranteed products. One thing to keep in mind, there's no loans that can be taken from 412(e)(3) plans as well, because you have to have that level funding just in case something happens or somebody leaves the plan or something. So you have to have that level funding on an annual basis. So that's what a 412(e)(3) plan or a fully insured plan is. It's a plan that's funded by an annuity or a blend of annuity and whole life insurance issued from the same company. You're going to be using guaranteed products and you're going to know what those contributions are on an annual basis.
So in the concept of life insurance, right, we know we have embedded guarantees in our products, but then we earn, let's say, interest credits or dividends or other additional revenue on top of the guarantee rate. Armando, is that what you mean when you talk about ratably and how you're earning the excess, which will offset future contributions like we talked about in prior slides?
Yeah. In these type of plans, we have, as you mentioned, the dividends. The option for these 412(e)(3) plans is dividends to reduce. premiums. So in future years, you're going to see in the illustration, I'm putting away $400,000 this year. In year 10, I could be putting away 375 or 370,000. Well, why is it going down? Well, you have these dividends that you're earning on an annual basis, and it's dividends to reduce. So it reduces that premium on an annual basis. So that's how come you're going to see that. And it's going to take these guaranteed earnings and reduce it on an annual basis on the annuity side and also on the life insurance side.
All right. So I couldn't help myself, Armando. I'm a spreadsheet kind of guy, right?
That's
So,
fine.
so let's say this annuity has a 1% floor and our deemed plan contribution is 279,000. We'll get into the specifics here. It's not really too important. It's a male 55 that's reaching a certain destination of 10,000 a month. But at 1%, right on the left, this is where the calculations are generated. Okay, assuming the annuity does not earn any interest, and this is an annuity only plan for simplistic just modeling, and it doesn't earn any interest above the guarantee. Well, if my destination is 2.9 million in year 10, I need to put away 279,000 every single year for the next 10 years. But if the annuity earns 4.25% each year, that's fairly significant excess growth over the guarantee of 1%. My contributions then look to decrease. And in the example you'll see is 279, 270. And by year 10, I'm down to 191,000. And I'm still driving to the same destination, which was roughly, call it $3 million in this particular example. So the concept of using a guaranteed product and insured products, that your contributions are heaviest in the beginning, you're getting to the same destination, and any excess interest or dividends will decrease your future contributions. So when you're in your peak earning years, right, it gives you a lot more stability to fund now and know you're going to get a little breather on the back end.
Correct. Yep. So kind of going back to that slide a little bit, the column on the left is showing what you're going to need at minimum on an annual basis. Whereas in the column on the right is showing if it's paying this interest rate, the 4.25, this is what you're going to be putting in on an annual basis based on that interest rate. The left is I'm prepared. I know I'm going to put away 279 a year, but if I'm earning great, guess what? It's going to be a little bit less, but I'm still going for that. We're still getting to that same target at the end of the 10 years, or maybe even more, depending on how much you're earning. So that's a good way to put that as well.
Very good. Okay. 2 ways to fund the plan. We talked about this. We talked about this, right? Annuity only and annuity life insurance. So I'm going to make just a quick comment. If you have studied whole life post section 7702, Security Mutual was the only company that maintained the highest level of guaranteed interest rate assumption of all whole life products. So I will tell you that the product is built for this particular purpose. I will also tell you that the product has a flexible premium annuity rider. So I don't need to go out and buy 2 very specific products and manage each of them. We buy one product, one application, deposits go in. If there were ever a need for the insurance to be paid off cycle or late, or there's a cash flow issue, the policy can internally pull from the annuity and you will not be deemed with presented with a 1099 distribution. So again, I opened the presentation with there's reasons why we partner with companies like Security Mutual. Here's a big one. This is a really big one. So as we kind of talked about, Armando, the defined contribution plans and defined benefit plans. Now, as we move into life insurance, how much life insurance can you buy in these programs?
Right. Well, in defined contribution plans, and we're talking about this for a specific reason, defined contribution plans, you can buy it two-way. You can put up to 25% of the plan's contribution towards UL, or up to 50% of the plan's contribution can go towards whole life on an annual basis. So say I'm putting away $50,000, I'm using whole life insurance. I could put up to $25,000 a year into the plan and purchase a whole life policy with that premium. Defined benefit plans, there's two ways you can do it. There's the 100 times rule, or 100 times the expected monthly benefit. Now, what this states is my monthly benefit will be, $17,000. So the 100 times rule will state the most life insurance you can get out of the plan is a $1.7 million policy. Now, I can tell you with some semblance of security that 99.9% of the plans sold do not use the 100 times rule. They use what we call the 74-307 method, which duplicates the defined contribution rules. That's why we talked about up to 25% towards UL and up to 50% of the plan's contribution towards whole life. Now, the 74-307 method is the most common. Nearly 100% of the plans go that method because you can get more life insurance into the plan. Traditional DB plan, you can use the UL or whole life, as we mentioned earlier. And with the 412(e)(3), the fully insured, you're using the whole life. So you're getting, if you're putting away $400,000 for yourself, you can put up to $200,000 towards the whole life premium for the participant on an annual basis. So that's why a lot of people go the 74-307 method. What does that also mean? That also means the more life insurance you're putting into the plan, the larger the plan's contribution is going to be. Because keep in mind, what are the, how much are you getting in year one on a whole life policy? What's the cash value? 0. So you got to put more into the plan in order to make sure when you retire at retirement, you're hitting your goal of 2.9 million or whatever that goal is, that lump sum benefit, that to get that $245,000 a year. So that's why you see a lot of people go with whole life and defined benefit plans, because they put more into the plan. It's a larger contribution at the end of the day as well. And as an agent, I mean, that's a nice selling point as well. I'm selling a very large whole life product.
It costs you a lot
They're
more
all
to buy
fully
it out.
commissionable. In
Yeah, it
qualified
costs you a
plans, they're
lot
all-
more to buy it outside of the plan, Armando.
Right. Yeah. How much would this cost out of pocket compared to in pocket? In essence, you're letting Uncle Sam subsidize your life insurance purchase. And you're getting a tax deduction for buying life insurance in a qualified plan using pre-tax dollars. So
Yeah,
some of
so-
the advantages.
Right.
Go ahead. I'm sorry.
So our end game, typically at Life Brokers, we love to create income streams. We love to create volatility buffer assets so that you can increase your income stream in retirement. Obviously, transfer wealth using life insurance. So far, we've talked about all of those things, right, on a tax deductible basis. So if you find the proper client and demographic, these fully insured plans have huge advantages, right? As Armando said, maximum tax deduction, no market risk. There's nothing complex about the funding limitations. This is the guaranteed rate. This is my destination. This is how much you have to put away. If I earn better than my guaranteed rate, you're going to put away a little bit less, but we're still driving to the same destination, right? And now we talk about life insurance. So where does the life insurance come in? And this has been a debate that I've been around for 20 years. Do I want to buy life insurance in the plan? Do I not want to buy life insurance in the plan? And you're going to you ask 20 people, you're going to get 10 different answers on one side on half of the 20 people and 10 different answers on the other half of the people. So let me give you some reasons why we think adding life insurance, and I'll give you even more like mathematical reasons on the back end of this presentation. But out of the gates, right? If you compare buying life insurance outside of the plan, you get more coverage from the same out of pocket by buying it inside the plan. It's just that simple because you're using pre-tax dollars versus post-tax dollars. The premium is tax deductible, right? So that's number one. Number two is that the income tax nature of the death benefit is still income tax free inside the defined benefit plan. You just have to recognize the economic benefit on an annual basis, which is somewhat nominal, right? You also pass the life insurance death benefit to your spouse using the unlimited marital deduction, and it's not included in your gross estate if you're worried about estate taxes, which right now with the exemption being so high, it's not typically too much of an issue, but it may be in 2026 when the exemption resets. And we have ways to remove the policy from the program anyhow. It creates a larger contribution, right? So if your goal is to drive income tax deductions and plan for your retirement, then that meets one of the objectives. And I would say that life insurance inside the qualified plan is even better protected from creditors than the creditor protection benefits you get using life insurance outside the plan. So there's some reasoning. And then we're going to show you like how to kind of bring this all full circle through a couple case studies. And we have about 18 minutes left, Armando. So we're going to dive into the ideal client. You know, we talked about mature, we talked about affluent, we talked about stable, we talked about committed, and we talked about the number of employees. The most common demographic we see are medical professionals. Doctors love these types of plans. Mind you, they have to own their own practice, right? They have to be their own business owner. They can't be purchased by a hospital system or a healthcare system. They have to be business owners. Lawyers, accountants, architects, writers, small business owners, contractors. I mean, you name it, software developers that have few employees. Again, keep to the ratios that Armando was talking about. I'm going to give you a fully insured plan numerics through case study number 1, and I'll turn this back to Armando. Nelson and Murdoch Law Firm. This is like classic example, 412 planning at its best.
Yep. Here we go. All right. We have a law firm, only 2 owners, husband and wife, mid 50s, early 50s, 55, 52. They have a lot of money. Combined income is over $1 million, but remember, we're limited to that $305,000 for this year for the contribution. So let's take a look at what we can do for the plan. Well, actually, let's look. Yeah, here we go. They want to put away as much as they can, and they want to get a life insurance benefit, or they're thinking about getting some life insurance. Here's the annuity only. Now we see both of them. They're at that annual max compensation of $305,000. We're at the maximum lump sum at retirement, given their age and their normal retirement age, which is 2.9 million. Now you could be looking at it saying, hey, you know, that $10,000, you know, 10,500 is not going to equal the $245,000 a year in a 412(e)(3) plan. Sometimes you're going to have that happen. Traditional DB plan, more or less you won't, but you have to go for what we call the lump sum at retirement. That's that 2.95 million. So 10 years for Matt here, he's going to get 2.95. After 13 years for the other spouse, she's going to get 2.95. If they decide to take this lump sum and annuitize it, they're going to get that $10,000 a month for life out of the plan. Now, you could say, well, I could probably do a little bit more using higher interest rates in a traditional DB plan. Yes, you probably will, and you're going to get more of that monthly retirement, but the likelihood of you getting that 279,000 and 211,000 equaling just over 490,000 in a traditional DB compared to the 412(e)(3) is going to be less likely. Why? Because you're using a guaranteed product with 1% interest rate. So that's what we're targeting. We're targeting that lump sum at retirement, that benefit, using that 1%. So you're going to have to put in more, because what we're saying is, hey, you're only earning 1% instead of, you know, earning 4.25%. So you're going to have to put more into the plan than you would if you were earning higher interest rate, which in turn means a larger plan contribution. And in turn, that also means a larger tax deduction.
Yeah,
so
no coincidence there, Armando. We use that 279 number in the annuity only plan. We're kind of bringing that back full circle here on 279 using the guarantee rate. as you earn excess, your 279 will decrease, right? As excess credits are earned in the policy. So well described here. So this is your annuity only plan, right? We're
Right.
driving to a destination of, call it $2.93 million at retirement. And Armando, is 2.9 the maximum lump sum you can roll out of a qualified plan? And no, right?
No. You can earn, you can roll out more. Going back to that slide you were just on before, depending on what the interest rate is paying on the product. This is based on the guaranteed. So you're going to earn a minimum of 2.9 at retirement. If the annuity is going to be paying more, like you showed earlier, I think it was over 3 million that they were getting at the end of 10 years.
Yep.
So you're going to earn more at retirement. We're just showing the minimum at this point. So again, and if you earn more, you annuitize that. Obviously, your monthly benefit at retirement is going to be more as well.
Sure. Well said. All right,
And
now
that
let's talk
lump
about.
sum, I just want to point out, take a second, that lump sum at retirement, you can annuitize it to get that monthly benefit, or you could just take that lump sum. You can roll it into an IRA. And there's no taxable event at that point. Could roll it into a profit sharing plan if they want, no taxable event at that point. Or they could just say, hey, we're each taking this 2.9 million. We're buying that home we always wanted on the lake. I'm buying that boat I always wanted. And then we're just going to blow the rest on airfare to go travel around the world.
Yeah,
But they're going to get taxed on that.
9 out of 10 times we're seeing that roll over to IRA.
Absolutely. Yep. 9 out of 10 times that does roll over because there's no taxable event at that point.
All right, let's talk about adding some life insurance.
Sure.
These gentlemen want to add, or these two employees want to add $2 million of death benefit. How does that work?
So we're still at that same, going towards that same lump sum at retirement, the 2.9 million. But now you'll see the annuity decreased, and based on the individual, their life insurance premium to get to the 2 million is now 63,000 for one and 54,000 for the other, totaling $118,000. That is $118,000 of fully commissionable premium for any agent as well. And they each get a $2 million death benefit as well. So now look, their contribution went up from, it was 400 and on the slide before was 4 something. I think it was like 490 something.
491. I annotated
491. Oh yeah, right there. 491 annuity only.
Annuity only
500, almost 533,000.
Right.
So you're looking at.
So just track with me here. $118,000 premium only increases the plan costs by $40K.
Correct. Yep.
Because the cash value in the life insurance policy makes up a portion of our destination, which is $2.9 million.
Mm-hmm.
Interesting concept.
Yep. And that's just because they wanted 2 million. They could do more. So
yeah, and we'll actually get into that. So so a portion of the $2.9 million destination, 423,000 for Mr. Murdoch is represented. 423,000 of the 2.9 million is represented through cash value life insurance.
Right.
Okay, let's juice it up a little bit. Let's show the maximum. Right? How much is the maximum insurance we can buy?
The max we can get for these two is 4.25. It might be like 4.256 or 254, but we rounded it up so they have a nice even number. 4.25 million for each of them. And now look at that premium, 251,000 from, what was it before, like 113?
Yeah.
So we've more than doubled the premium, and the plan's contribution is just under $580,000 a year for the two of them.
There's a range of insurance, and of that is $4.25 million policy, 900,000 of the 2.9 million of destination resides in cash value life insurance.
Now I just want to real quickly touch on that. Imagine if something happens to one of them while they have this plan in place. Not only are they going to get that benefit at retirement, and not only have they saved that money contributing to the plan on taxes, but say, Murdoch died in year 9, that's a $4.25 million death benefit that the spouse is going to receive as well from the plan.
Yeah.
plus whatever cash value has accumulated. But keep in mind that that cash value is taxable, but that 4.25 million is not taxable. So that's a large chunk of change if, God forbid, something happens to one of the participants while they're participating in the plan.
Let's spin this just a little bit differently.
Mhm.
Now we have
the two owners. Yep. With one employee who's age 35. Still the same, still income over that. They're still looking to save for retirement, and they want to get at least $3 million each. So here we still have that $2.9 million goal at retirement, that lump sum falls under the 415 limit. You can see here, life insurance for the two of them is, just over $276,000 around there. $176,000 for the two of them. But you might be saying, hey, the employee's only making $40,000 and they're getting a contribution of $12,000. That's a lot. And yeah, it could definitely look like a lot, but keep in mind, the owners are putting away $566,000. And of that, they're getting, 553,500. So they're getting probably around 97 cents for every dollar they're putting into the plan.
Great ratio.
Plus, that's a tax deduction for them as well. And it's a great benefit to give to the employee, because somebody who they really like, who's worked with them for a while, in order to keep them there. So that's something that's great as well.
All right, Armando, let's hope for the best here and assume that everyone gets through normal retirement age and they're still alive.
Mm-hmm.
This life insurance, if I had it and I didn't use it, fantastic. Was it the greatest deal in the world? Could I have just purchased 10-year term, especially if I'm going to surrender it out? And this is the voice of the naysayers, right? The non-qualified plan advisor mindset. But I would argue there are five types of exit strategies.
Right.
One is death while in service, right?
Yeah.
Which is the home run.
Right.
Two is surrender the policy by the plan, which, okay, that 10-year term argument starts to, reinvigorate itself.
But you can counter that by saying, were you going to get that tax deduction by paying the term policy?
That's true.
Outside of, in the plan, you're getting that tax deduction where you wouldn't have gotten that buying a 10-year term policy.
That's true. I don't particularly like number two. Where we start to have fun is in 3, 4, and 5, right? So number 3 is you can distribute the policy to the insured participant. So, all right, let's look at this particular contract. $3 million of death benefit, $635,000 of cash. It is in theory, or could be, paid up through a reduced paid up option. I distribute this policy to the participant and they owe $635,000 of ordinary income tax, which you can either utilize outside funds to recognize that tax, pay that tax to the IRS, or take a policy withdrawal and then take full ownership of a non-qualified, fully paid up whole life policy. Pretty amazing. I'm going to show you what we do with that in the next slide. Number 4, you can sell the policy to the participant or the participant's trust at the fair market value. So if a high net worth client is gifting and they're putting their trust in a position to buy things, to transfer wealth, maybe, just maybe, at the end of retirement, that trust will want to buy the life insurance policy from the qualified plan at the fair market value. Again, this could be a whole nother 45-minute seminar, but that is a huge strategy that we use with ultra high net worth clients in using seasoned money or the existing whole life policy here. And number 5, Security Mutual. Again, why they're such a terrific partner. Net amount at risk exchange rider. So what does that mean? It means this. If there's a $3 million death benefit and $635,000 of cash value, Security Mutual will issue the participant a brand new policy at their attained age, guaranteed issue, no medical questions, in the amount of the net at risk, which is in this case $2,364,690 outside of the plan. You can have your spouse own it, your trust own it, you can own it personally, your kids can own it, you can take it in the form of whole life, universal life, any type of policy you want. It's a wonderful strategy if you're estate plan focused. Where I'm going to back up a second is if you are income focused, and this is straight from the slides in case study 1. The annuity only plan drives to the destination of 2.9 million, right? We all know the 4% distribution rate, right? The whole, we've done countless seminars on this strategy, probably even lower at a 3% distribution rate. Well, let's give it 4. You're looking at $118,000 of annual income to protect yourself against market volatility, sequence of returns, etc. Versus having split that 2.9 million between, I'm just going to annotate this for a second here, split that 2.9 million between cash value life insurance and the annuity. Still same destination of 2.9 million, except in this case, you have a volatility buffer asset, which gives you the permission slip to spend more than 4% and increase that to 6, which increases your annual income to 151,000 from 118, because you have 2 years or more of buffer plus a $2 million death benefit. Yes, you have to account for $156,000 of income tax due because you're distributing a policy worth $423,000, which is a far less valuation than the premiums you've paid in. And this becomes a very practical planning tool where it comes right back into our wheelhouse of creating income streams, managing tax brackets, and insulating against market volatility and sequence of return. I can talk about this subject for hours. I will also tell you that you're also in a position to look at 2 other bonus strategies. One we talked about in Pension Max, where you buy the policy from the qualified plan, but you're also given the opportunity to look at covering the asset, where you take the life income pension benefit, you're creating the maximum income stream, and then you back that up with the remaining death benefit utilized through the attained age exchange, so that if you died early in the process or early into your retirement years, the death benefit replenishes that value to your family. Wonderful planning tool. So you're looking at 3 major exit strategies here that can benefit the client, give them options once they approach their retirement age. So I'm going to tell you how we can help. So Security Mutual and Armando have advanced marketing support. We can provide you with a fact finder. They'll help you with a plan design in conjunction with our office. Not only do they help design the plans, but they underwrite the policies through Security Mutual Life Insurance. And they also wholly own a subsidiary called Security Administrators, Inc. They're an actuarial firm out of Binghamton and Syracuse, New York. They'll do the plan documents, the plan administration. They'll finalize the plan design. I have personally been through 9 audits with SAI. We passed every single one with flying colors. They do a tremendous job for us and for our clients, and I highly recommend them. So
I just wanted to actually point out, not only do I do the design work as well, but I jump on calls all the time with agents, their clients, their attorneys, their CPAs, whomever they want to discuss the plan with. Be more than happy to do that with anybody as well, just to offer a sense of security and answer any questions anybody might have.
Thank you, Armando.
Yep.
Thank you. So we've done a pretty good job, Armando, in weaving in the participant questions throughout the presentation. Everything has been answered at this time. So I'll bring this webinar to a close and say, Armando, thank you for joining us. 'Tis the season for tax deductions and qualified plans. We are not in the typical rush that we normally would be in adopting plans by December 31st, but as clients have a better picture on what their finances and their profit and loss and balance sheets look like at this point in the year, it's the opportune time to talk about installing one of these programs.
Absolutely.
So the slides will be circulated to all participants in the form of PDF, and today's presentation will be recorded. So we thank you for joining us. Everyone stay safe and enjoy the rest of your afternoon.
Thanks, everybody. Thanks for the opportunity, Anthony. I appreciate it.
Thank you, Armando. Great job.